I'm Greg Hunter. Welcome to USAWatchdog.com. Last week, a wild ride in the markets. I booked this man a couple of weeks ago thinking that things were going to get dicey. I had no idea how dicey they would get. Hundreds of points off the stock market, yo-yoing up and down. Perfect timing for Michael Pento of Pento Portfolio Strategies, also a published author, expert on bonds, the markets, gold, silver, you name it. Michael Pento, thanks for joining us today on USAWatchdog.com.
Thank you so much for having me back on at such an auspicious occasion.
Well, you have been warning for a while. I know the timing's, way off for a lot of people, but they printed more money than anybody would ever imagine them printing with all the stuff, shenanigans going on with the DOD and Department of Ocasio-Cortez brought up that $21 trillion. I believe I talked to you about the DOD and HUD can't find. But anyway, I digress. What a wild week. What is your snapshot of what is going on in the markets?
Okay, well, I have more than just a snapshot to give you. First of all, kudos to you, Greg, for having me on. And I'm not bragging about myself at all. I'm just thanking you for giving people a platform and a venue to come on shows like yours. Because I've been banned from CNBC, as I'm sure your audience now knows. Maybe they don't like me, the way I look. Maybe they don't like my face. Maybe they don't like the fact that I badmouth the Federal Reserve for being counterfeiters. I'm sure that's probably a big part of the reason. But that's what they are. I mean, they counterfeited about $3.8 trillion since the Great Recession. And they like to be called what they are. So I guess that's the reason why I'm banned. But people like you have me on programs like yours so I could tell your audience ahead of time. In fact, in April, I was on your program talking about the top 8 reasons that you want to head for the exit, the very narrow exit door by the fall. And I gave those 8 reasons on your program. Almost every one of those 8 reasons came true by the fall, and the market has completely fallen out of bed. And it's not just the United States, by the way, it's all over the world. So I want to thank you very much for having me on your program, because I think even if I'm not always right, and believe me, I am not always right, and my timing is not always perfect by any long shot. But here's what I knew. I knew that printing $14 trillion globally by central banks, counterfeiting $14 trillion, and taking interest rates to 0% for a decade was not a long-term and viable solution for what ailed the global economy coming out of the Great Recession. Okay, so debt and low interest rates and asset bubbles caused the Great Recession of 2008, and it sure as hell wasn't going to be remedied and rectified by doing much more of all of the same things.
So are we at the point that you were so fearful about, you were warning people, get out, get out, get out, sell, 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 run, Forrest, run. Are we at the point, is it going to get better? I guess the guys at CNBC are going to say, oh, buy the dip, buy and hold for the long term. What do you say to that?
Everybody, CNBC is always best to listen on mute, Greg. Not your program. You turn the volume up when you have guests on, not just me, but other guests. You want to listen to what they have to say. So CNBC is telling everybody, hey, listen, here's my guest who's going to tell you when it's a buying opportunity. And they'll usually draw some silly lines and say, the 200-day moving average is here, and this is a support level over here. And, all these things are meaningless. I have a 20-point model. It's the inflation and deflation growth model. One of the components of my model is something called an inverted yield curve, which I warned about that was going to happen by the fall. Well, here we are. The 2-year note is inverted to the 5-year note. And let me just tell you, that means that the 5-year note yield is lower than the 2-year note yield. So part of the yield curve has inverted right on schedule, and this is a precursor to having the 2 and 10-year note yield curve invert. And when that happens, the clock's ticking towards a recession. Could be maybe 6 months away, could be a year away. In my opinion, Greg, it's going to be much, much sooner because of the outrageous level of debt that we have and the untenable asset bubble that it was supported and built upon. So let's just look around the world. And when I said this back in April, that you should head for the exit by the fall, that was a prediction. Let's just go over a couple of numbers. So look at commodity prices. Do you know that the price of oil is down 33% from its peak. The price of lumber is down 43% this year from its peak. Why are these economically sensitive commodities crashing if everything is great? So the Shanghai stock market, the Chinese stock market, is down 27% from its high of this year, and down 50%, cut in half, since the year 2015. Italy and Greece are both down around 25, 27%, depending on the day. 45%, Greg, of the S&P 500. This is before I calculated the data today. So 45%, almost half of the S&P 500 is down 20% in a bear market or more. So this is no longer a prediction. The fact of the matter is that the U.S. economy is slowing down dramatically. The growth rate of earnings is slowing down dramatically. And the overpriced asset bubble that was predicated upon a globally synchronized recovery is over. It's in the rear view. And believe it or not, and I think you're going to believe it, the market is still very expensive where it sits today, even after this bloodbath of a week that we had last week.
So the question is, how bad is this going to get? What do you foresee?
Okay. I'm sorry to cut you off. I just wanted to mention one more thing before you ask your question. The nuts and bolts of what's going on here, in my humble opinion, is not about trade. It's not about Trump. What's happening here is we have a globally synchronized hawkish lean towards central bankers. So they used to be all in their money printing ways, or every one of them. But if we look around the world, 14 of the biggest 20 central banks are cutting back on their interest rate hikes. The ECB, the European Central Bank, was printing 80 billion euros each and every month. They're going to zero by the end of December. That's only a couple of weeks away, Greg. The Federal Reserve is burning $50 billion of cash each and every month. They'll burn $600 billion in fiscal 2019, which started this October. So you're having a tightening of global monetary policy, and it's coming on top of the fact that China is a communistic basket case of a nation that printed $38 trillion in debt between the year 2000 and today. $38 trillion, went from $2 trillion to $40 trillion in debt, all centrally planned, all forced upon the economy as an edict from the government. Those are the two things that you can be concerned about. And rising interest rates are causing things like the economic sensitive sectors like housing and autos to crash. You know, the home builders are down 25% this year. Home building stocks are down 25%. They lost a quarter of their value from the high. Okay, this is very real. It's a very dangerous situation. We're going to have another recession, in my opinion, in sometime in 2019. And when a recession rears its ugly head, like it did the last two times, investors lost 50% of their nest eggs. Don't be a victim. Do not be a passively managed pigeon. Once again, you don't have to be.
How bad is this going to get? Where do you see? Are we going to get massive deflation, then inflation? I got a call. I haven't called him back yet, but he's such a smart guy. Nenner says the worst is yet to come on the stock market. We're going to get a little bump before the end of the year, and then look out below. This is Charles Nenner. What do you say about that?
Well, okay, so I have to say it's silly for me to sit here and predict, and nobody knows exactly how bad it's going to get. I think it's going to get much worse, but I have a model that tells me how bad it's going to get. I'm looking at the yield curve dynamics. I'm looking at LIBOR. Okay, let's just talk about LIBOR for a second. I hope I'm not too much in the weeds here, but if you manage money, you can't just say this and this is going to happen at this time and then stick to it. So I have an actively managed portfolio, and I look at things like LIBOR, OIS spreads. So it's the cost of the euro dollars over in Europe, dollars over in Europe, 3-month dollars over in Europe, as opposed to the Fed funds rate. You know, LIBOR has gone from 0.3% in 2016 to 2.77% today, as of last week. Greg, that's the number that's ascribed to about $370 trillion worth of derivatives and loans. So the interest rate on these loans and these derivatives is skyrocketing. So you ask me how bad things can get. Let's just look at earnings. So earnings for the S&P 500 by the end of this year are going to be about $162 per share. Now Wall Street, the silliness of Wall Street is still predicting a near double-digit increase on these earnings. But I don't see how the heck you get a double-digit increase on earnings. You've had rising wages, a stronger dollar, crumbling emerging markets, weakening Europe. By the way, Germany in Q3 was into a recession, in half of a recession. They had a negative print on Q3 GDP.
0.2%.
I'm sorry?
0.2%.
Yeah. So GDP in Germany, which is a big, healthy bastion of success in the flawed European model, is in half of a recession. Q3 in Japan was negative. Chinese auto sales are plunging. They were down 5 or 6% in November. The November data that was for October. And I actually have data that says auto sales are down double digits in December. Okay, so how can an economy, China says they're growing by 6.5%. How can an economy be growing by 6.5% and have auto sales down double digits year on year? Is that possible? Does that sound right to you?
It doesn't.
So the global economy is imploding. Europe, Germany is in half a recession. Japan is in a half a recession. China is crumbling under their pile of debt. And yet somehow Wall Street tells us that earnings per share are going to grow, 10% next year. I think let's say that the worst scenario doesn't play out and we get $160 per share on earnings next year. And if we just get a normal multiple on that, 15 times, you're still way overvalued where the market sits today. You're still way overvalued. But Greg, I don't think you're going to get $160 per share. I think you're going to get something much less than that. And I don't see any reason why you're going to slap a normal 15 multiple upon that. So we have, at least in my opinion, 20% more to go on the downside from here. And that's, I hate to say this, but that's probably a very rosy and optimistic scenario. We could do much worse as far as earnings per share is concerned.
How bad?
We could have a reset. We could have a 10%, 15% haircut in earnings very easily. And then you slap a 10 or 12 multiple on that. And then you're talking about a 40 to 50% drawdown from here. And let me just hasten to add, I know I'm talking a lot here, I promise.
No, I'm happy you are.
I just want to hasten to add that the firepower from central banks just isn't there anymore, Greg. I'm thinking about what is the nation of Japan, the BOJ, going to do if we enter a global recession? And Japan's halfway there, as I already mentioned. Are they going to lower interest rates in Japan? They're already below zero. Is Japan going to go back into QE? They never ended QE. So what is the Japanese central bank's balance sheet, the BOJ's balance sheet, is greater than the entire economy of Japan. Over in Europe, it's almost 50% of the economy. And like I said, here in the United States, we printed $3.8 trillion ex nihilo. So the firepower to automatically just take interest rates down by hundreds and hundreds of basis points doesn't exist anywhere in the world.
Wow.
And just going back into QE is sure as heck ain't going to work in Japan and Europe, because Europe's still printing 15 billion euros a month. So the firepower just isn't there. So people will tell me, the Federal Reserve is going to, we'll talk about that. I want to talk about that in a second, about Jerome Powell's coin flip from being hawkish to dovish.
Yeah.
But the Federal Reserve and the ECB and the BOJ and the PBOC do not have the firepower to automatically turn the ship around like they did in 2009. So be careful.
I want to talk about this executive that got arrested at the request of the United States and Canada
Canada, yeah.
And because of some type of, allegedly some type of business with Iran through HSBC,
Well,
and they're going to prosecute.
She supposedly flouted the Iranian sanctions.
Well, China
selling
is
cell phones to Iran. I find this what I find kind of interesting about this whole thing.
Okay.
Again, I do not want to concentrate on a trade war. Let me just say this. Did the United States make peace with Canada and Mexico a few months ago?
Yes.
Okay. Did that help Canada and Mexico in any way, shape, or form with their stock market?
It doesn't appear so.
No. So what's bothering what's bothering China and the United States, it has a little bit to do with trade, but it's not the answer. It's not the primary concern. But what I find interesting about this whole thing is while Mr. Trump was having dinner with Emperor Xi Jinping, maybe he knew about it, maybe he didn't. John Bolton supposedly knew about it, but he had Canada, on our behest, arrested this young woman who is really the princess of all technology in China. So it doesn't engender a lot of goodwill for the trade negotiations.
No.
But I do think this, and I am not a pessimist. I do think there will be some resolution, a beneficial resolution to the trade conflict very early in 2019. Because I think Donald Trump is just obsessed with the stock market, and he's looking for any kind of win at all. And you might get a temporary reprieve in asset prices. A long-term panacea? Not a chance.
I wanted to bring up one thing that's been really bugging me in terms of calling for a recession and that kind of thing. I had Nobi Prince on here, and she basically brought out, and other people have said the same thing, that we were 160, 165, I don't know, 170 trillion. It's tough to come up with, but some $165 trillion in debt in 2008 globally, and we ran it up to 250 trillion. So my question to you, so my question to you is this: when you have that kind of a debt explosion, do you need a very big recession to blow it up?
No, not at all.
Can you talk about that?
Not at all. So the debt of the globe is up 40 percentage points. Okay, $70 trillion since 2008. That's one of the theses that I have. Why I knew that this wasn't going to end well. Rising. When you have debt that's 350%, or I think it's 333% of global GDP to be precise. When you have debt that's tremendously huge, you need low interest rates. It's mandatory to have zero interest rates. Otherwise, that debt is not serviceable. And here in the United States, 14%. I heard this figure. Found this figure today. About 14% of the S&P 500 companies are zombie companies. So they don't have the EBITDA, cash flow, to service the debt. So they have to issue debt to service the debt, not pay off the debt, Greg, to service the debt. So these companies are zombie companies. They shouldn't be in existence. When these companies go under, 2/3 of corporate debt is BBB or less. And the quality of BBB is at the lowest it's ever been. We have $9 trillion, Greg, of corporate debt. And when you throw collateralized loans in there, leverage loans,
derivatives,
this economy cannot sustain itself on higher interest rates. Now the Fed is wedded to these asinine models which predict inflation. So they're saying, I still hear people in the Federal Reserve saying the global economy is fine, maybe slowing down a little bit. The U.S. is very, very strong, but we have to kind of, maybe slow down our rate of increase of interest rates. So can I touch on that?
Sure. Oh, yeah.
I just want to briefly touch, on October 3rd, Jerome Powell said that, and I'm paraphrasing here, the Fed funds rate, which is the overnight interbank lending rate, is still very far away from neutral, and it must go above neutral for some time. This is October 3rd of not 2010, 2018, October 3rd. Now the stock market, to show you the financialization of the United States and indeed of the world, The stock market goes down 10%, not year over year. The averages go down 10% from their high. And Jerome Powell says on November 28th, well, maybe we got to just slow down. We're kind of close to the range. Now, what Jerome Powell did not say, there's no doubt in my mind that the Federal Reserve is beginning the process towards what I feel is going to be a reduction in interest rates back to zero in QE. But it's it's going to be a longer road than most people think, or the stock market can endure. But they're on that road. But what Jerome Powell actually said is that the Fed funds rate is close to the range of estimates. What are the range of estimates, you ask? The range of estimates are from 2.5% to 3.5% on the Fed funds rate, and neutral being around 3. So again, it's nuanced, but it's important. The Fed is close to the range, but the range has a bottom, a middle, and a top. So I think the Fed goes in December. Part of my job enables me or demands that I go out on a limb, and I live my life out on that limb, making predictions. Some of them are wrong. Most of them are correct, verifiably. But I think the Fed is going to raise interest rates this month unless the stock market completely falls out of bed. So another 10% or so drop from here would put them on hold. If that doesn't happen, because we had a non-farm payroll report last week, which was not terrible. Okay, 155,000 net new jobs. So it was not terrible. Unemployment rate remained static at 3.7%. Almost was 3.6%, by the way. It was a tenth of a point. But the Federal Reserve is going to raise interest rates in December, and I think they're going to continue raising interest rates slowly in 2019 and continue to drain its balance sheet. The balance sheet's on autopilot. They're burning $50 billion. They're destroying this. It's very important to understand what they're doing. Okay, 2 seconds of the interview. The Federal Reserve has bonds that mature, and then they go to the Treasury and say, "Hey, we need this cash," and the Treasury has no money, so they float a new bond to the public at a public price, take the money, and send it over to the Fed, and the Fed destroys it. They burn it, and bank credit tightens, and that's why you see LIBOR OIS spreads blowing out. You see junk bond spreads blowing out, things that I model in my portfolio.
Deflation.
I'm sorry?
Debt destruction.
Deflation. Say it again. Deflation.
Debt destruction.
What the model told me to be. We're headed towards Sector 1, which is a deflationary recession/depression. That's what we've been modeled for. That's why the portfolio was short in September. In the model portfolio, we covered the week before, the day, I think it was the day before Thanksgiving, we covered, because I think would be some bull-ass, complete BS from Trump about China and this meeting with Xi Jinping. I thought Powell would go dovish. And then now we reshorted in the model portfolio Monday morning before the crash. So we're in the portfolio. We're shorting when the market is euphoric and when the VIX, the volatility index, is very low, and we're buying in panic when the volatility index spikes. That's one of the main things I'm doing with my model.
This is deflationary depression. I mean, the picture you're painting, zombie companies, explosion of debt. Aren't we headed for one giant, huge reset, default, crash? Aren't we headed for that?
I think we are. I've been predicting that I didn't predict it would happen years ago, but I said that's eventually where we're headed, Greg. Eventually, we're going to completely reset the currency, like Germany had to do following World War I, and Hungarian Pengo had to do. Hungary had to do in World War II. But it's going to take one more iteration or cycle of inflation to get there. So we're right now we're deflating. We've been deflating for a while. We're going to have a deflationary panic in the stock market. It's no longer predictive. It's happening. In fact, I think it's going to happen all over the globe. And on the wings of that,
so wait a minute. Hold on, just a minute. Hold on to your wings. Just so people know that this is going to be Puerto Rico. You have a bond. Sorry, you're not getting paid. You made a bad.
There's $4 trillion of unfunded liabilities in the public pension system.
Okay, sorry. Okay.
You don't get your money. Okay, the stock market goes down. Social Security is bankrupt. Medicare, Medicaid is bankrupt. All of these social programs are bankrupt, and the stock market tanks. And what are they going to do? What do they have to do, Greg?
Inflate.
They're going to have to go to inflation, but inflation is going to be more than what it was last time. Last time, what did the Fed do? So the Fed said, I'm going to pretend to care about people, but what I really care about, what I really, really care about is banks. So I'm going to print trillions of dollars. I'm going to take banks' bad assets from them. Okay, I know your mortgage-backed security is worthless. I'll take that from you with a slight haircut from par. And then I'm going to pay you interest. It's called IOER, interest on excess reserves, because I don't want you to lend the money out to the public. Screw the public. I don't give a damn about them. It's my business and my priority to protect you, Mr. Banker. They didn't. The Fed did not send, as far as I remember, correct me if I'm wrong, the Fed didn't send checks to mom and pop who were defaulting on their mortgage.
No.
They sent checks to the primary dealers so they can take their assets off their balance sheet and then pay them interest on excess reserves so they wouldn't lend out those reserves. Okay? That's what happened. But then, go ahead.
Go ahead. Well, go ahead. Finish your thought. I have one more question.
But in the next iteration, the next turn of the cycle, I don't think it's going to be good enough to just pay interest on excess reserves and blow up the balance sheet. I don't think they can do that. I don't think that's going to be successful. They can only lower basis points. I think this is kind of funny that since we have $22 trillion national debt, 105% of GDP, which is phony, by the way. Our GDP is mostly phony because it's predicated on 0% interest rates. You borrow money, you pull consumption forward. If we had a real interest rate, the economy wouldn't be anywhere near where it is today, $20 trillion economy. But I think what's going to happen is that instead of just going back into QE or lowering interest rates by we only have 225 basis points to lower the Fed funds rate. The economy can't even exist. The financialization of the United States can't even exist on an interest rate that's not even real. Real interest rates. The real Fed's funds rate is 0. And look what's happening to the stock market.
Minus inflation, 0.
To the economy. I think that's hysterical.
You're saying the real Fed's fund rate is 0 minus the inflation.
So the Fed funds rate the effective Fed funds rate is 2.2. You subtract inflation, which is about 2.2, you get this, which is a big goose egg. And that's enough to crumble the entire asset bubble economy.
And what about gold and silver?
Taking away that 225 basis points or 220 basis points isn't going to be enough. They're going to have to print money, but they want that money to be lent out. So that's when I talked about things, again, going out on my limb. They're going to have negative real interest rates. They're going to ban cash. I can feel it coming. It's going to be a universal basic income is going to be universal. Everybody's going to get a check for college, for Social Security, for retirement, for food, for energy. That's what's going to happen because they have to understand this, please. And I hope I can do a good job of explaining it. They cannot just put cash in the banking system and let it sit there. They have to get the velocity and amount of money circulating into the economy. So they have to circumvent the banking system. How they do that is by directly monetizing treasury debt. The Fed, central bank, has to print money, send it to the treasury directly, and have the treasury borrow and spend it into the economy.
What happens?
That's what's going to happen.
What happens to gold and silver? Shouldn't they be taken off already?
Well, they are. I mean, if you look what happened last week, with every little utterance from the panicking central bankers. This is why I'm banned from television, by the way. But they're panicking because they know that they know that the total market cap of GDP is 1.5 times the economy. So that is unheard of, Greg. It's completely outlandish, stupid, fatuous, and scary all at once. We should be about 50% of the economy. The market capitalization of stocks should be about half the GDP, not 1.5 times GDP. But they understand that when the stock market goes down, consumption and the wealth effect crumble, and the economy is going to falter. So they're going to have to pursue a radical inflation gold. That, by the way, I want to. You asked about gold and silver. When they do this, when they change from a central bank, which feigns the ability to raise interest rates to a normal level and drain its balance sheet, to one that admits that they have permanently monetized $4.5 trillion of debt, and they will only be able to increase the size of their balance sheet and never be able to drain it and never be able to raise interest rates. I mean, gold that's been suffering, gold and silver that have been suffering since 2012 are going to rip higher like they've never.
Oh, there you are. You're back. Okay, good. So when they have to admit they're going to monetize that $4.5 trillion, gold and silver are going to go to the moon, right?
Yeah, I mean, I got to tell you something. After 6 years of suffering, gold and silver and the mining shares are going to have, I believe, a rocket ship higher. And I don't want to use hyperbole, but they've been suppressed for so long under the belief that the Federal Reserve can drain its balance sheet, that deficits were going to be very low, 2 or 3% of GDP, and there'll never be another recession, and the dollar was going to be king dollar forever. All those things will be cut. All those things will be turned on its head in 2019. That's my prediction.
And gold and silver is, you'd be buying physical. If you're a poor guy, you'd be buying gold and silver, physical coins, U.S. Eagles.
If I was a poor guy, or if I was a rich guy who wanted to maintain his purchasing power, I would be purchasing physical gold and silver, mostly gold.
Michael Pento, Pentoport Strategies, Pento Portfolio Strategies, I should say. Their website is pentoport.com. That's where I got confused. But Pento Portfolio Strategies, Michael Pento, thanks for coming on in a tour de force to explain what's going on last week and the last few weeks and what's coming down the pipe. Of hyperinflationary depression, am I getting that right?
We haven't seen stagflation like what I see coming ever.
Oh, boy.
That includes the 70s.
Michael Pento, thanks for coming on and joining us here on USAWatchdog.com. I'll put up all the links to Pento Port. You have free stuff there. I think you have a podcast. People can get a hold of you if they want you to, employ your services. Michael Pento, thanks for joining us today on USA Watchdog. Oh, go ahead.
May I say happy holidays and a very blessed and Merry Christmas. God bless you.
Merry Christmas to you, my friend, and happy Hanukkah to our Jewish
yes,
brothers and
absolutely.
sisters. So,
absolutely.
Anyway, hey, listen, thanks so much for joining us today, Michael Pento. Pentoport.com is the website. Pento Portfolio Strategies is the business. Michael Pento, thanks for joining us today on USAWatchdog.com.